Disclaimer: this video is for educational and informational purposes only. It is not financial advice. Always do your own research or consult a licensed financial professional before making investment decisions. Welcome to Money Mindset, where investing finally makes sense. Today we're talking about one of the most powerful, underrated, and beginner-friendly strategies for building wealth: dollar cost averaging, also known as DCA. If you've ever wondered how to invest without stress, without timing the market, and without needing a PhD in finance, this is your strategy. Let's start with a simple question. Why is investing hard for most people? It's not the math, it's the emotions. Markets go up, markets go down, and most beginners panic, hesitate, or invest at the wrong time. That's because humans are terrible at predicting the future, and even worse at handling short-term fear. This is where dollar cost averaging becomes a superpower. Dollar cost averaging means investing a fixed amount of money into an ETF on a regular schedule. Every month, every week, every paycheck, no matter what the market is doing. High? You buy. Low? You buy. Boring and flat? You still buy. You remove emotion, remove timing decisions, and let the power of consistency work for you. Imagine this. You invest $200 every month into an ETF like an S&P 500 tracker. In months where prices are high, your $200 buys fewer shares. In months where prices drop, that same $200 buys more shares. Over time, this automatically lowers your average purchase cost. And you don't even need to think about it. Your consistency builds wealth while reducing the psychological stress that destroys most investors. But why does this matter so much? Because markets are volatile. No one knows what will happen tomorrow, next month, or next year. Even professionals fail to time the perfect moment to buy. And the biggest mistake beginners make is waiting for the right moment, which often means missing out entirely. With dollar cost averaging, you skip that trap. You stop worrying about timing and start focusing on building long-term habits. Let's look at an example. Imagine two investors, Sarah and Mark. Sarah invests $200 every single month into an ETF for 10 years, rain or shine. Mark, on the other hand, tries to time the market. He waits for dips, looks for opportunities, and only invests when he thinks it's a good time. After 10 years, guess who ends up with more money? It's almost always Sarah. Why? Because consistency beats guessing. The person who invests regularly wins against the person who hesitates and tries to be smarter than the market. And here's the best part. Dollar cost averaging works beautifully with ETFs. Why? Because ETFs already give you diversification. You're not buying a single stock. You're buying hundreds or thousands of companies at once. When some companies drop, others rise. When sectors fall, others grow. Your regular contributions spread risk, smooth volatility, and build a long-term snowball of wealth. Let's go deeper. DCA also protects you from one of the greatest threats in investing: volatility. Markets often move violently, especially during crises. Without a strategy, investors panic sell or stop buying at exactly the wrong moment. But with DCA, market crashes become opportunities. When prices are low, your fixed investment buys more shares, turbocharging your long-term returns. The 2020 crash, the 2008 crisis, even the dot-com bubble. Anyone who dollar cost averaged through those periods and held long-term ended up with massive gains. Another key advantage: psychological freedom. You don't have to analyze charts. You don't have to watch the news 24/7. You don't need to know whether the market is overvalued or undervalued. Your job is simple. Invest the same amount consistently, let the system run, and trust the long-term trend. Historically, markets go up over decades. DCA simply ensures you benefit from that journey without the anxiety of constantly making decisions. Now, DCA isn't magic. There are moments when investing a large lump sum might mathematically outperform DCA, especially if markets trend upward immediately. But here's the catch. Most people don't have a lump sum. They invest monthly because they earn monthly. And even when people do have a lump sum, they often struggle emotionally to invest it all at once. So, dollar cost averaging becomes the best practical strategy, not just financially smart, but psychologically achievable. Let's also talk about automation. Most brokers allow you to automatically invest every month. This means you set it once, you forget it, and your wealth grows in the background. It takes discipline to get rich, but automation makes discipline easy. So what ETFs work best with DCA? Broad, diversified, low-cost ETFs, S&P 500 ETF, MSCI World ETF, Global All-in-One ETF, or even bond ETFs if you want a more stable mix. The key is long-term consistency, not the specific ETF dollar cost. Averaging is like building a financial engine that runs forever. Your only job is to fuel it regularly. Here's the truth. The secret to long-term wealth isn't picking the right stock or timing the perfect dip. It's showing up month after month. Dollar cost averaging is simple, boring, predictable, and that's exactly why it works. So if you want a strategy that de-risks your emotions, protects you from market timing mistakes, and builds real wealth quietly in the background, dollar cost averaging is one of the best tools you have. If you enjoyed this breakdown, hit like, subscribe, and turn on notifications. We post new videos every day. And comment below. Do you use DCA or do you prefer buying dips?